Why mutual funds sahi hai? Not so obvious but truly encashable reasons. Simplicity, accessibility, diversification, variety, affordability, low expenses and professional management are the benefits of mutual funds as explained by mutual fund distributors and AMCs. Let's dive deep into the not so obvious but truly encashable benefits of mutual funds. If you can understand and implement them in your investment strategy, this could be a game changer. I am sure you would agree on the majority of the points below. 1. The disclaimer with mutual fund, i.e., mutual fund investments are subject to market risks, itself makes you think twice before investing in it. 2. Either you yourself or someone you know well might have had a bad experience of investing in a mutual fund. Hereby bad experience I mean either getting negative or very low returns or less than expected returns on your investment, or even seeing a negative or very low return at some point of time during the investment journey. 3. About 40-50 years ago, people used to blindly follow celebrities. I mean, if Amitabh Bachchan is endorsing something, we must try it out. This is not the case anymore. With the advent of technology, information is readily accessible to the common man, and that too at your fingertips and at lightning speed. This makes celebrity endorsements less relevant in this day and age. So, what influences our decision-making process? Well, like all buying decisions for ages, all our buying decisions are based on either emotions or logic. Marketers use all the emotional reasons to sell their products and services. So, I won't be touching upon the emotional aspects of buying decisions. Most of the sales reps would say mutual fund gives you flexibility in and control over your investments. It has expert management, so on and so forth. However, it hardly appeals to our logical brain. I promise to give you super logical, almost no-brainer, reasons to invest in mutual funds if you watch this playlist of 3 videos. Before understanding why mutual funds sahi hai, let's understand the different asset classes, how much return each asset class has yielded, and asset allocation. Asset classes. Any investments we made can be broadly classified into any of the 5 asset classes. 1. Cash and cash equivalents. Cash itself, money in savings bank accounts, etc. are an example of cash and cash equivalents asset class. The asset class gives minimal return but represents purchasing power. Any money which could be easily consumed is considered cash and cash equivalents asset class. 2. Fixed income. As the name itself suggests, this asset class gives a fixed return on our investment. It is lending your money to get a return on it. Bank fixed deposits, public provident fund, etc. are examples of fixed income asset class. 3. Equity. The most dreaded and frightening asset class among all is equity. This asset class is perceived to have higher risks. I have marked the word perceived with italics fonts because it's just the perception. Here, you need to understand each investment comes with some risks or others. No investment is risk-free. Equity is ownership of the business. Investments in stocks, equity mutual funds, funding a startup is a few examples of equity asset class. 4. Real estate. While the above 3 represents the financial assets, real estate is one of 2 widely used physical assets. While you can't always feel the presence of each financial asset, real estate is an asset class whose physical presence can be felt. Land, plot, house, flat, etc. fall under this category of investments. 5. Precious metals, gold. Precious metals, gold in particular is another physical asset in which people can invest. Now that you have a basic idea of asset classes, let's look at the returns generated by each asset class over the last 10 years. Returns across asset classes in India. The first section in the table shows GDP data and inflation. The second section viz. Bank deposits, S&P BSE Govt bond and S&P BSE corporate bond represents fixed income asset class. Third section viz. Sensex and BSE 500 represents equity asset class. The fourth section realty means real estate asset class, and the last section of gold is representing precious metal asset class. Now, I want you to observe the table. You will come to know that equity, real estate and precious metal asset classes have inconsistent returns. What I mean by inconsistent is sometimes the returns are in double digits, sometimes in single digits, and few times the returns are negative. The returns on fixed income asset class are consistent across the period. By that I mean it has no negative return and fairly predictable single-digit returns throughout. If you observe, you will find out that there are occasions when the returns from fixed income asset class are below the inflation. This is a negative real rate of return, meaning you are losing money instead of getting a return on it. This thoughtful analysis of returns from various asset classes tells us that no one particular asset class is best when it comes to investing and getting returns. Each has its benefits and drawbacks. This is where asset allocation comes to your rescue.